Is Bitcoin having an accident or a systemic process creating long-term scarcity in digital assets? You are a long-term investor, planning for future wealth, believing disciplined allocation will compound over time. But what if Bitcoin's built-in halving mechanism contributes to structural scarcity that influences value in ways traditional assets cannot match? Today, we're analyzing Bitcoin halving cycles, the macroeconomic mechanisms of supply reduction that affect long-term investors through scarcity and adoption dynamics. The data reveals the truth unmistakably. Bitcoin supply capped at 21 million coins, halving every 4 years, cutting new issuance 94% already mined by 2026, with post-halving history showing multifold appreciation in prior cycles. Stay with me to the end. This isn't just code. It's the clear analysis and path to financial independence that could help position in volatile markets. The explanation provided and experienced by long-term investors like you is that Bitcoin is a volatile digital asset, with halvings as technical events that may influence price temporarily. That supply reduction is interesting, but not fundamentally different from other assets. But look closer. Why do halving cycles consistently coincide with supply shock and adoption waves, reducing new coins while demand grows? Why does fixed 21 million cap create scarcity absent in fiat systems? Why does post-halving performance show patterns across cycles? Insight 1. Scarcity isn't created by demand alone. It emerges when supply growth slows while adoption accelerates. This isn't isolated events or speculative hype. It's a systemic process rooted in Bitcoin's design that influences value through supply mechanics. Neat Bitcoin isn't just digital money. It's the mechanism that rewards long-term positioning in scarce assets. History shows pattern. 2012 halving, supply cut 50%, price multifold. 2016 and 2020 repeated amid growing institutional flows. The result? Network value compounds as supply tightens. For long-term investors believing time in market beats timing, the reality is clear. The mechanism has been in place, influencing outcomes over cycles. Intriguing? Yes, but how do these cycles work? How do these halving cycles work? So you know you're not missing the bigger picture. It's not abstract code event alone. It's a programmed reduction in new supply issuance, shaped by Bitcoin's protocol and network growth. Picture it as a built-in scarcity engine. Every 210,000 blocks, approximately 4 years, reward to miners halves dropping issuance rate. Institutions and adopters enter as supply slows. The process works through stock-to-flow dynamics. Fixed stock, 21 million, versus declining flow. Deep dive, by 2026, post-2024 halving, daily new coins approximately 450, down from 900. 94% mined flow rate lower than gold. Real-world impact. Adoption grows. Institutional allocations, nation-state reserves. Demand meets tightening supply. Insight 2. Value doesn't require constant growth. It compounds when supply constraints meet steady adoption. It's continuing. Current signals, institutional inflows record highs, nation-state interest, El Salvador model spreading, show cycle ongoing. Saifedean Ammous notes, Bitcoin's fixed supply mirrors sound money principles. Lynn Alden notes, halving creates predictable scarcity in digital era. Insight 3. Cycles aren't random. They follow supply schedule, allowing positioning ahead of flow reduction. History's pattern is clear halving precedes adoption waves. These mechanics shape outcomes as investor returns compound over time. But understanding the cycle is the first step gaining clarity. Now explore the mechanisms at the core Bitcoin halving cycles, so you see exactly how they affect long-term investors building wealth. It starts with protocol design. Satoshi coded 21 million cap and halving schedule, reducing issuance predictably. Cycle continues. Miners secure network, adopters join. Scarcity activates. Flow halves, stock-to-flow ratio rises. Bitcoin surpassing gold post-2020. Institutions allocate, demand grows. Long-term investors benefit from compounding scarcity. Everyday impact, portfolio allocation to scarce asset preserves value amid fiat expansion. History shows pattern. 2012 to 2016 cycle 10,000% gains. 2016 to 2021 1,000%. 2020 to 2024 multifold amid institutional entry. Current signals indicate continuation. 2024 halving complete. Adoption accelerating. Insight 4. Protection doesn't require perfect timing. It rewards consistent exposure to predictable scarcity. Lynn Alden notes, Bitcoin's supply schedule is unique, no dilution risk. Milton Friedman, only fixed money supply prevents inflation tax. Insight 5. Wealth compounds not from growth alone, but from owning assets with constrained supply and expanding systems. The process isn't speculation, it's systemic, influencing long-term opportunities over time. Think of it as scarcity flow, your allocation navigating abundance elsewhere. But here's the pivotal shift. You don't have to remain exposed to fiat expansion alone. Stop navigating as part of traditional current. Adopt the independent mindset. Understand the mechanisms, then position strategically. Conventional approach, diversify stocks/bonds, leaves you in inflation flow. Your purchasing power influenced over time. Redirect instead, question every unlimited supply narrative. The clarity comes realizing scarcity grows from halving mechanisms, gain independence, auditing exposure to dilution. Insight 6. True long-term advantage isn't chasing returns, it's holding assets the system can't print. How much portfolio in unlimited assets? Shift to independence. Allocation outside dilution's reach. History shows affected stay in fiat current. Independent thrive, preserving value across cycles. Practical step. Consistent exposure to fixed supply assets resisting expansion. You're no longer in the flow. You're the one charting course in abundant waters. This isn't speculation, it's pure clarity. You're positioned to turn mechanisms to advantage, emerging stronger from cycles. This is your initiation into true clarity. The deliberate path to financial independence through Bitcoin, halving cycles affecting long-term investors. None of this is financial, investment, or trading advice. It's purely educational macroeconomic analysis for awareness. Always do your own research and form your own conclusions. Bitcoin is digital gold, limited to 21 million coins forever, halving every 4 years. No one can print more. Impossible to confiscate like 1933 gold. History has proven it outperforms every traditional asset class during fiat stress cycles with multifold appreciation post-halving, such as over 10 times gains after the 2020 event amid unprecedented printing. The 2024 halving cut new supply issuance in half again, with 94% already mined, making it increasingly scarce over time, the only asset truly immune to inflation by design. In eras of monetary expansion like today, this fixed supply property has positioned it as the ultimate tool for wealth protection, preserving value when everything else erodes. Start your initiation. Read The Bitcoin Standard by Saifedean Ammous for the fiat parallels that will blow your mind, or The Sovereign Individual by James Dale Davidson, mapping the shift to individual sovereignty. Follow thinkers like Ben Cohen for cycle data, Lynn Alden for macro signals. Actionable. Self-custody wallet, consistent dollar cost averaging into Bitcoin as your scarcity anchor. This is the key to viewing money as your servant, not master. If this analysis has brought clarity, the drive to secure true independence, commit now to the next layer. Subscribe as your mark of joining this community of financial clarity seekers decoding the system together. The next insight is waiting.